Well, first of all, thank you everyone for joining us today. My name is Eunice. I'm the growth lead at Funnel. For those whom we haven't had the chance of meeting yet, Funnel is Southeast Asia's largest private investments platform. We leverage technology and data to curate opportunities in growth and pre-IPO companies for our global network of over 15,000 investors. Follow us on LinkedIn and Facebook at Funnel. We would love to keep in touch and hopefully meet you in person at our upcoming monthly mixers, actually, for family office investors in our network. The first of which is a whiskey tasting event happening next Monday, 29th of March, with our partner Diageo. Do stay with us until the end of today's discussion to find out more about how you can get in on this whiskey tasting. So just some housekeeping before we kick things off. We'll be taking questions via the Q&A feature. You can find the button at the bottom of your screen. So feel free to send us your questions at any point during the event. We'll also be recording this session. So if you have to miss any part of this webinar, don't worry, we'll send you a copy, or you can go check out our blog after this. So enough of me talking. I'm excited to introduce you to our panel of experts today. And I'm really looking forward to listening to their perspectives on the best practices, risks, and opportunities for family offices, private investment strategies in 2021. Especially, as the ASEAN region is coming out of this pandemic and, from witnessing some renewed interest in the future of private investments amongst a growing number of family office investors within our network. Our roundtable today will be moderated by Hanwi Tan, partner wealth and asset management consulting at EY Singapore. Making up our roundtable panel, we have Carlos Camacho, my colleague, head of investments development at Funnel, Hui-Ting Koh, partner at Altara Ventures, and Marco Cora, managing director at Azimuth Investment Management. Okay, now it's really enough from me. I'll leave it to Hanwi to get the introduction ball rolling. Hanwi, over to you.
Hey, hi everyone. Thanks, Eunice, for the intro. I guess over the next 45 minutes or so, we want to really touch on the key topics here. First of all, some background on myself. I'm from EY. I'm in the wealth and asset management practice. We work a lot with some of the asset owners, private banks, investment firms in the industry. So, certainly over the last year or so, we've been seeing quite a bit of macro themes around COVID, just social and economic and the way of life, right, has fundamentally changed. And it'll be interesting, I guess, in this panel to think a little bit about how these themes have changed investments in the private investment world. And in particular for family offices, we want to talk about how the FOs are pivoting towards a new way of investing, right? On the panel, very, very excited to have Marco, Carlos, and Hui-Ting. So let me dive right in with some of the questions and thematics, right? So let's just start with, I guess, a broad sweep of the landscape. I think, throughout the whole of last year, given COVID, it'll be interesting to sort of think about what are the significant concerns that family offices today have in terms of investments, and what are some of the challenges that they think about when it comes to private investments. Maybe I can hear from the other panelists, starting with Marco, if you have some view.
Yeah. So I mean, and even before answering that, one thing I want to say that we noticed very, very much here is that one of the key concerns of our ultra high family is the risk of not being able to do in the future what is possible to do today. So setting up a family, setting up an investment process, it's an unpleasant exercise. It's long, it's daunting, it's exhausting. And so many are interested to explore, but tend to postpone it. What we saw instead is last year was the biggest year in which a lot of conversation that we have been having for years, all of a sudden all materialize. And especially in the context of the second gen. So we do a lot of, we have a lot of clients who are second generation. And they are all, you know, they were working for their own startup, or they were working for financial institution or consulting firms. And now they're all telling me, you know, uncle decided, now I have to resign, I'm setting it up, let's go, let's do it, you know. So they moved, probably the realization that situation change, obtaining PR can become more difficult, even traveling from one country to another can become more difficult. And so this kind of carpe diem, you know, get to the opportunity when there is an opportunity, and don't wait to maybe see how things will change in the future. So that I think is the key difference that I saw last year among our clients.
What about Carlos, from your point of view, family offices, investment side, what were some of the, I guess, obstacles and challenges that you see?
Yeah, I think maybe just to take a step back a little bit and talking about the industry in general in terms of private investing, I think now we're seeing a lot more interest from the family offices, and I think it's a good time because I think two main forces, right? I think the first being around kind of the innovation economy. You know, we've seen our world digitalizing at this pretty crazy rate, and it's only been accelerated by the pandemic. But I do believe that some very iconic companies, maybe the next generation of FANG companies, will come out of being born in this time. You know, something I've said for a while now is that, you know, the best startups are often forged in times of crisis. So just look at the list of companies that started around the 08-09 GFC. You've got Uber, WhatsApp, Pinterest, Instagram, Slack, Square, you know, the list goes on. And part of this increased digitalization and innovation, I think, is also because of an increased productivity. You know, the development of software today, I think, is roughly 5 times more productive than it used to be. And that's, you know, not because people are 5 times smarter, even because, you know, software tools are that much better. I think a lot of it is driven by the advent of open source technology, which allows developers to build, you know, on top of things that have already been built before, leading to exponential growth. And if we look at open source software on the distribution side, we really see the power of the free business model, you know, which gives the ability of smaller companies to, you know, give away, you know, valuable services away for free. And then suddenly they're able to dominate a market in a totally new category. So you can just look at the MongoDBs and MuleSofts of the world for good examples of that. I think the second force driving this is really around the private equity markets and the abundance of capital. So some people can say there's an oversupply of capital right now, and that can be a challenge, but it can also be a very positive thing. You know, launching a company today might be cheaper than before, but it still takes a lot of capital to grow a company. And now that, you know, companies are being built up faster than ever, that also means that they consume capital faster than ever. And on top of that, companies today are staying private longer, and this increases the need for more capital. And that just makes sense, right? The time frame for liquidity has stretched out a lot. In '99, it used to take an average of you know, 2 to 2.5 years to take a company from inception to IPO. Now it's more like 6 or 7. So that kind of leads to your original question of, you know, what I see is some of the biggest obstacles for family office investors in private equity, and that is more around liquidity in my view. You know, PE and VC investors are challenged now to have longer holding periods, but at the same time, you could say that the longer holding periods allow them to have larger returns, as they're not giving away those returns to the public. On top of that, I also think that the secondaries market is really at an inflection point right now, with more and more capital flowing to the secondaries market, which benefits both entrepreneurs and investors as well.
So those are good points, Carlos. Certainly, I think in this environment, there are both challenges and opportunities that are opening up, right? And some of the firms that we see, you know, the firms that can capitalize, I guess, on the opportunities that are opening up will you know, be the ones to look towards. We think, I guess, a quick one from yourself in terms of challenges and really the macro drivers, right, in this environment around investments and family offices. Any thoughts there?
Yeah, I mean, what we saw last year was a lot of family offices not actually wanting to make investments into funds, especially because of exactly what Carlos said. They wanted to maintain liquidity. And a lot of that is because I think a lot of the traditional family offices, especially in Asia, have a lot of their wealth in like the public markets. And, the volatility in the public market last year was, 99% of the family offices I had spoken to, they were, up to their eyeballs, just trying to manage that volatility. So I think that was one of the challenges, especially for last year. But we're seeing that turnaround now. Given that everyone's kind of gotten a little bit more used to, working and living in this new normal, they're beginning to, reconsider their portfolio allocation. I think a lot of the family offices we have spoken to recognize that, there is some benefit in diversifying where you want to allocate your resources, right? And so that's what we're beginning to see. Family offices today are a little bit more receptive to talking to us, to actually considering alternative investments.
Okay, good. I guess maybe we can then pivot into some of the deeper questions. I guess if you look at the crisis, right, that we've had around COVID, and really, these crises have happened before. The Asian financial crisis, the GFC. How do you think the current pandemic, right, is different from the previous crises that we've come across? Is this environment different from previous environments that we've faced, and what's the investment thematics, right, that are different today as compared to the past? Perhaps I could start with Marco from a I guess portfolio side within this crisis versus previous crisis, right? What are some of the differences that you see?
Yeah. In general, we think the crises are all very different from each other and ultimately very similar in that they lead to systemic shift in, actually they should be the time in which you apply systemic shift to your major broad belief about how to invest. If we look at our clients and also how we advise them to behave, we see that there is a very strong shift in general from public markets, traditional public market, so developed market equity and bonds, into less traditional public market, investing in China equity, investing in subordinated bonds, investing in CLO, but still relatively liquid listed markets. And that's one shift. And the second shift that is actually the most prominent is the emergence of this private market exposure. And historically, private markets would, in general, still today, private markets are difficult to invest. There is a critical aspect, which is the liquidity aspect. And so you need to manage your liquidity constraint much more carefully if you have an asset that you can liquidate only after 5, 7, 10, 12 years. And it's getting longer and longer over the past 5, 6 years. And this is one aspect, but the other was around the complexity of doing the research, the complexity of actually implementing an investment. And that's where technology is really coming in to help. So what we see a reduction in the amount of assets that is required to do a proper allocation into private markets. The second big development is a shift from allocating into, say, a general purpose private market, like used to be, mega cap buyouts, private equity, you allocate to big brand private equity fund manager, to start to take more control over the allocation, or to allocate to sub verticals that are more specialized. So for example, in Azimut, we set up a company in the US that does buy minority stake in GP, where we deploy our own capital through an LP. We allow our large clients to participate as independent LP. We create package LP for smaller allocation for also our client. And we work with these companies to create co-investment opportunities. And very consciously, rather than going into general purpose private markets, we went into niche markets. So for example, we invested in a fund that does opportunistic credit, which worked very, very well in 2020. So it was we were very lucky that this was a particularly interesting space to be. We invest in a fund, we are looking to invest in a fund that is doing venture debt, which is also a special type of venture investment, which is quite interesting with different characteristics. We are launching in Singapore a venture capital fund focusing on blockchain, which is another interesting aspect. And also in general, as was said also before, much more willingness to take complexity in the family, to understand it, because it's worth it. And partially is linked to the fact that, as Carlos was saying before, there is this huge amount of liquidity that is pushing up prices of everything, and hence forward return of everything that is easy to buy, but also because technology is helping us now to participate into this market in a more efficient way. And this is, I think, the key change that we saw in portfolios.
Definitely, so agreed. I mean, the two shifts that you mentioned definitely are very topical, right? The shift from public to private, and within the private world, going for more control, more direct, more niche kind of investments. And you know, my personal feel on the crisis, right? This crisis compared to the previous one is certainly around the scale and the social economic impact, right? The previous ones were a little bit more financial. The current COVID one does fundamentally change and let us rethink about the way we interact and the way we live. So, you know, it also opens up, I guess, disruption, right? Opportunities for disruption and change. Maybe Hui Ting, on a similar question, right? From your perspective, from a portfolio management side, what are your thoughts, right, around the current pandemic? And maybe if there are obstacles around the portcos or the portfolio companies themselves for family offices, how do they handle this in this environment?
So you're talking about portfolio management for family office or portfolio management of a fund?
Portfolio companies, I guess, right? So if you were investing in a portfolio company, how do you help them sort of steer or strategize through this environment, right? To do value creation and operationalize a bit better.
Yeah. So for Altara's portfolio companies, I mean, we were quite lucky in the sense that we had made most of our portfolio investments just before the start of the pandemic. So going into the pandemic, our portfolio companies were all pretty well funded, you know, with 18 to 24 months of runway, which is for us it's a basic kind of criteria when we make an investment into a company. So what they did, what our portfolio companies did was really focus on, you know, product enhancements, cost optimization. There was a lot of focus on how do we build the sense of team and community remotely. And we saw that, you know, for the portfolio companies that actually can kind of preempt or predict how bad it could get based on what was happening out of China, they were a little bit more prepared when the pandemic actually hit their market. So for example, we have a portfolio company that's an unsecured consumer lending company in India, and they could see the lockdowns happening in China starting in December. Thankfully, he was an experienced founder, and so he really course corrected much earlier on, much earlier than some of our other portfolio founders, and really, you know, managed to communicate with his entire company to get everyone single-mindedly focused on collections. Since they were a lending company, collections was one of their biggest key drivers or key challenges.
Good. So maybe let me move on to a next topic, right? And just going back to the environment and how, you know, from a socio-economic perspective, the environment that we're in today, having been majorly disrupted, you know, with the lockdowns and basically human interactions and activities being restricted, although we are slowly easing out and opening up. what I guess are some of the ways that you know, companies can tap on this opportunity, right? In a sense, are there ways that family offices, for example, could make an impact in this environment? I know that, for example, digital is going to come out in a bigger way because you know, simply because there's remote access, there's a move towards digital. Ideas around that, right? In this environment, what are some of the thesis or the areas of pivoting or acceleration that family offices can look towards? Maybe I'll start with Hui Ting. Would you have some view?
Yeah, I mean, I can speak for some of the family offices that are invested in us. And you know, the way that they play a really vital role for our portfolio companies, in the sense that, you know, a lot of the family offices in Asia tend to, you know, come from core, you know, traditional businesses. And we view that as very strategic to our portfolio companies, simply because they're a great way for the portfolio companies to essentially, you know, strategically test their product or their service to see if there would be a good product market fit. So in that way, family offices for us play a really important role. For my specific family office is a little, I can speak from that for a little bit. We are different in the sense that, you know, we tend to invest at very, very early stage direct investments. So this tends to be angel or pre-seed. And that really serves to essentially just fuel the entrepreneur ecosystem. What we really are trying to do is build the ecosystem within Southeast Asia so that more people actually want to become an entrepreneur. More people feel like, you know, they have the opportunity to go out and find a real problem that's worth solving. And then, you know, for us at Altara, because we're investing at slightly later stage, so Series A and B, we get the benefit of that in the sense that we then get to see all of these entrepreneurs, and we've known them for a while before, you know, they start needing to raise Series A.
Mm-hmm. Okay. Maybe pivoting to Carlos, right? In your context, do you see any trends in this area? Again, given the environment, what do some of the investors out there, family offices, what are the thematics that they see, and maybe something around the social economic change, or, you know, even things like infrastructure and access areas, right, that they can think about.
Yeah, I mean, thinking about socioeconomics, I guess I've definitely seen kind of a new wave of interest in ESG and impact investing. I know you mentioned impact earlier as well. And we saw this trend already starting kind of even before the COVID period. You know, I read somewhere recently that from a survey that around a quarter of family offices are now engaged in impact investing. So it's definitely something that's trending upwards. You know, I've seen a lot of, I guess, what I like to call karma investing from families who, for example, are maybe from the logging or timber industries, and they set up a green fund, or families that are in the energy sector and they set up a fund to invest in renewables. But I think the majority of the impact investing is actually coming from a more global investment trend that I kind of find hard to bet against. And that's kind of this growing concern around things like climate change and social and financial inequalities, as well as corporate responsibility. And I think it used to be that impact investing felt more like, you know, donations to nonprofits maybe. But these days, I think there's a big difference in that many social enterprises are now, you know, they're not forgetting about the business side of things and really focusing on maximizing the double bottom line, which is a measure of both fiscal and performance and social impact, basically. In terms of what's driving impact investing, I think today, I think there are a few factors. The first would be the consumer. So I've been looking up a bunch of surveys recently from last year, and a lot of them, I think one said that around 80% of consumers changed their preferences based on sustainability. On the other side of that, Around 60% of companies saw their revenues rise after implementing various sustainability initiatives. And over 2/3 of those companies saw their customer loyalty increase. Another force, I think, driving this is around talent. A company's commitment to sustainability and being socially responsible, I think, is becoming essential to attracting and retaining the best talent, especially among this millennial generation. Another survey I saw showed that around half of new workers said they would only work for a company with sustainable business practices. So I think that's moving now into tangible results in the investing world. For many investors, I know CVC is doing this, at the PE giant. Focusing on these two forces is now kind of entrenched in their processes for growing a company's market share as well as increasing their deal multiples. I think there's this growing belief that the traditional focus on boosting EBITDA is actually less effective than focusing on customer loyalty and things like employee satisfaction. The last factor I would probably point to for the impact investing side would be around the banking and regulatory systems and how they're affecting the sector. I think there are more and more governments these days passing policies to incentivize sustainability-focused companies and deter those that are seen as environmentally or socially harmful. China, I think, and some of the governments in Europe are particularly aggressive about these reforms. But aside from regulations, we're also seeing the rise of sustainability-linked credit facilities, such as loans with rates that are tied to things like water savings or other ESG indicators. So with all these, I really do believe that the trend towards impact investing isn't only about doing good and saving the whales one plant-based burger at a time, but it's also about recognizing what consumers, customers, and investors really want and turning that into a strategy that really creates value.
Mm-hmm. Yeah, so those are in fact themes that we do see from my side, from EY's perspective, in many of our clients. Clearly a shift towards, I would say, looking at ESG from a more a bigger factor, right, in terms of investment decisions. Previously, it might have been more compliance-led, where you do reporting and so forth. But we are certainly seeing that a lot of clients want to put ESG as front and center as part of their investment process. The MAS, in fact, recently did issue some guidelines about environmental risk management. So your points are squarely on point, Carlos. And maybe we can move on to the next topic. I guess looking ahead, if we think about Marco, earlier you mentioned the public and private market, clearly a shift towards private. Looking ahead, what do you think in terms of the years to come, right? Given that the public markets are volatile, private markets increasingly give that long-term smoothing out of performance, and particularly for family offices, because it's in a way patient, right? The capital is patient, and they can sort of hold it out over the long term. What do you think about the ways that family offices might deploy capital into private investments going forward, Marco?
And maybe I can also partially answer some of the questions I saw in the chat and the Q&A, because it's linked to this, the going direct versus co-investing, which is co-investing versus investing in PE, VC. So the way we see our clients operating, and we agree, we also advise them to do the same, is to consider private markets as a component of your asset allocation. So in order to do that, funds are efficient. Is an efficient way of doing it, because you get exposure to multiple underlying, you get professional deal flow and deal sourcing, you get all these things, you get the due diligence, and some of these fund management companies developed their techniques over many years, and they have proven ability to deliver alpha. So value for money is there. One thing we advise our clients in this context is, I touched upon before, is rather than going for only brand and for the traditional private markets, like buyout in particular, which we think is all the liquidity premium that is essentially what you get in buyout firms. now has been compressed to so much that it's debatable whether it compensates the liquidity risk the families take by allocating into this space. But there are other private markets that are not yet saturated and where the risk premium that they exploit is still very, very strong. In order to express some specific thematic conviction, high conviction ideas that the family has, or special skill set or special access to certain markets, many of our families also allocate directly, and they tend to do it through the help of technology, or if they are large enough, of course, they have their own team that can help them. I want to also though say something else, it's kind of a meta answer, no, in the sense that it's not really one versus the other, because investing in funds is also a very good way to get some of the deal flow, to be able to see that. So sometimes there is a second reason to invest in fund, which is to partner with the fund management company and start to see that deal flow and being able to co-invest, outsourcing a portion of the due diligence to someone else. At least you can consider the fund as a screening agent, that source the deal, does an initial screening. If it's good enough for them, maybe it's good enough for you to take a look. And then to consider, right? So this is very, very powerful, and is definitely a valuable resource on top. So the answer is a mix. I would say it's good to have allocation to certain funds for the, say, beta to this part of the market, but then many families will tend to co-invest, and often they use the first to achieve a better result with the second.
So certainly a trend towards either co-investing or a more direct approach for family offices, right?
There is definitely an increase. It has always been more desirable for families to do it, but historically it was very difficult. And so this trend is also justified by improvement in the ability to do it more easily.
So flipping to maybe another topic, early versus growth stage investments, right? We think, there are some stats out there, for example, from Camden FB, 70% of respondents' investment capital, right, is going towards growth stage companies. What do you think in terms of the early versus growth stage, and your views, right, in terms of investments? How are these being allocated today?
Yeah, I mean, I think it's very similar to what Marco was saying. It's all about portfolio allocation, and it also depends on, the personality of the family office and what amount of risk they're comfortable with. So, for example, for us, the family offices that are invested with us, they set aside a certain amount within their portfolios to allocate to early stage investments, because that's what we do. But we also know that they are also active in making kind of growth or late stage investments as well. A lot of the family offices that I'm familiar with, they want to be able to take advantage of, let's say, the IPO pop, right? And that's, again, it boils down to portfolio allocation and risk appetite of the family office. A lot of the family offices, especially within Asia, are still primarily, decision maker is still the patriarch. And that tends to be a little bit more conservative. And so the way that, we talk to our family offices, really we're addressing kind of the second generation. And we're basically saying, you know what, keep doing what you're doing. That has worked. We're not trying to change. We're not trying to reinvent the wheel for you. But given that digital is the new future, and technology is going to play a part in the second generation, third generation, it's not something that you can avoid. And allocate a small amount of your portfolio now to tech-enabled or tech-forward or future-looking investments, right? So that you guys are, you're ready when the future arrives, for lack of a better cliche. And a lot of, and we encourage them to do it with a fund, not because I think because our day job really is to look at and to scour the landscape for every tech-enabled investment possible within the industries that we cover. And we offer, we say to the families, like, invest with us, and if you want to go direct, you have the opportunity to co-invest with us as well. And really that's because we're saying, take advantage of our ability to due diligence. We are essentially, we do this day in and day out. We're looking at 1,000 companies a year. I cannot imagine how large a family office would have to be looking at those numbers of investments. But especially if you're an early stage investor, you do need to look at the numbers because so many startups fail. Now, are we saying don't do any early stage? No, but we're saying it's a portfolio allocation.
Yeah, so definitely, I think in terms of funds, they do give family offices the opportunities, right? We think to access deals, have that broader sort of early stage exposure, which they can't necessarily do on their own.
Yeah.
Maybe flipping over to a more platform discussion, right? Carlos, earlier we talked about, and in fact the same topic, right? How do we better allow access to deal flows to family offices? Do platforms make a difference? And I recall, Marco, as well, you earlier talked about structures, right, where you are able to maybe chop up investments into smaller ticket sizes to allow access to a wider market. Let's go with Marco first. What are your thoughts from a platform perspective in easing or facilitating family offices in terms of assessing deals?
We think is very important, and it's almost an enabling factor. Without it, it's extremely difficult. The family should be either very, very interested in the space and over allocating as compared to an average portfolio to the space, or it must be huge. So for example, if you want to allocate to a KKR fund, you need the $10 million minimum per vintage. If you want to have multiple vintage to have a little bit of diversification across market cycle, say 10, you need $100 million allocated to the space. And if you want to diversify across, 5 managers, you need $500 million deployed to just the PE space. And not very few families can do it. If that's 10% of your portfolio, it's not something for the average family to consider. So technology there is very useful because we can, we work with many partners to do this, and they can shrink the minimum investment size, still giving you access to KKR, for example, but in chunks of 100 to 250,000. So all of a sudden, because you have 2 scale of magnitude less, a family with 30, 40, 50 million, they can have their 10% relatively diversified allocation to the space using funds. For co-investments, of course, so the panel is organized by Funnel. They, I can say they are one of our partners. We have been collaborating very much, and technology there helps screening, reducing the number of the universe that you can consider from tens of thousands to a few hundred. That becomes more feasible, and that's one thing, for example, that they do. Technology allows to represent these investments in an easier way. So this tokenization, not something Funnel do, but one of their group companies, HG, also does. And for example, we in Azimut just did one such exercise in Italy, which we announced yesterday, I think, or 2 days ago. And this is extremely interesting. It lowers the cost of transaction from thousands of dollars to single-digit number of dollars, so by 10 or 4 or 5 order of magnitude. And this makes this investment tradable, so more liquid, reduce the minimum size that is required to invest. So technology here is going to be extremely disruptive, and will enable investors to invest. And this is on the demand side. On the supply side is also probably important to notice the company remain private for longer. And so the good company are the ones that don't list. And so it becomes almost even more desirable to partake into this space, because the company that list are the less interesting ones. So the only thing that is left in the traditional public market is really the simplicity, the fact that with an Interactive Brokers account, I have 4 million stocks and bonds that I can buy. And that's pretty much the only thing left there. But the private market are becoming very similar. And right now, they are not as easy as buying Apple shares. But it's foreseeable that in a reasonable near future, they will become pretty much the same.
Mm-hmm. Carlos, your views, I guess, from a funnel perspective as a platform, right? What are your thoughts in terms of providing access?
Yeah, no, firstly, thanks for the plug, Marco. Appreciate it. But I guess when talking about deal flow with family offices, I think it's important to focus on quality deal flow, right? I think a lot of the family offices in Asia, in our region, especially those smaller outfits, that Huiting mentioned, they might not have the resources and the teams dedicated to looking at private equity. Those types tend to be more trend driven, and I've noticed that a lot of their private market deal flow actually comes from their private bankers, who serve a purpose, don't get me wrong, but I don't, think generally are the best sources of quality deal flow in the private markets. I think our business in general is, PEVC is really all about working with people across different firms and expanding your network to get the best deals, which isn't, very scalable doing, face to face, especially in today's world. I think this is especially true in Southeast Asia, where venture, the scene is still very nascent. And it's nascent enough that investors still look at each other as potential co-investors. So there's still a lot of, information sharing and collaborating going on, which may not be as prevalent in more mature ecosystems like the Valley, for example. But of course, as Marco mentioned, I have to mention platforms like ourselves, who really, aim to curate deal flow for our investor base, many of whom are family offices. And for free, I should add. So that's always a plus. But in this pandemic world, like I said, meeting people in the industry to get deal flow isn't as easy anymore. So using online platforms like ourselves, I think, is a great way to get connected to the community. I think, we're part of this new wave of companies bringing data and making it more scalable in the way we think about private investing, using our data and algorithms to screen companies and match them with relevant investors. And we also try to have something for everybody, whether it's direct primaries, we facilitate secondary trades as well. We work with fundraising for PE and VC funds, bringing down those minimum tickets, as Marco mentioned, and going even into luxury items like rare whiskeys. So I think using a platform is a great way for, some of the family offices that are newer to this industry to get exposure and really learn more about different sorts of alternative assets.
Yeah. In fact, that's a good segue, Carlos, into some of the trends that I've been seeing, right? For example, in the fund space, for investors, really the private markets have traditionally been very, I would say, high touch, right? Relationship based. And to the extent that you can industrialize the deal sourcing and the deal flow, either through a platform or really just having the menu and the suite of deals, it helps a lot in the efficiency almost, right, of the deal process for family offices. So we are certainly seeing a lot of interest in PE firms, in investment firms, on the private market side, trying to digitize, right, the deal flow process, and really even using analytics to comb through deals and scour for opportunities that were maybe previously unknown. So I do think that the platform view that you mentioned, right, contributes to that in a big way. I would just maybe end off a little on maybe some of the thematics around. Marco, you mentioned crypto, and Carlos, you mentioned luxury investing. What are some of your thoughts around these areas? Are these, on the uptick in terms of interest? And do you see them as up and coming? Marco, maybe crypto.
Yeah, I think maybe the community can also give us some feedback on the chat, but I think crypto is very interesting, very topical, and not just the cryptocurrencies, which are of course interesting in their own right. I find them interesting on a personal basis, but I think blockchain as a technology to change the way in which, very high level, in which we interact with each other. So the way that today we interact with each other is regulated by either authority. So you rely on the fact that you can take people to court, or by intermediaries. The blockchain allows mutually distrusting parties to coordinate and collaborate, and that's amazing. It's a new technology, and this will enable a lot of different things. So our thesis is that either you are sure that this is not going to work, in which case, of course, the right investment is no investment. But if but this is a difficult position to take of pretty much anything. So unless you're sure, you should enter. But if you are not sure that this is not going to work, because of the potential for this intermediating the traditional way of life is so big, a small allocation to digital assets, to direct investment in companies that develop on blockchain, to funds that invest in the space is probably a good idea. So that's our take internally. We are also a user of the technology. As I was saying before, a couple of days ago, we announced that we are tokenizing an asset-backed security, a tranched asset-backed security, actually, in Italy first. So this is a semi-pilot. So as far as I know, is the first real-world application globally, in the sense that there has been a lot of proof of concept done before by companies. And I can give you an example. Société Générale created a bond, tokenized it, and then bought it all back. So they proved that they have the technical ability to do it, but there was no real client, no real. In our case, real financing went to real small and medium-sized companies in Italy, and real client will get real yield paid by these companies. And the transaction, so exchanging these assets, is all done on chain, on Ethereum actually, which is also quite scary for some, but interesting for others, at least for us. So this is quite an interesting thing. That so as a firm, we like the technology. We think the technology is great. We think the applications are great, and for diversification purpose, it's probably a good idea to look at it for everyone.
Sure. Carlos, your views maybe on other thematics like maybe luxury.
Yeah, I wouldn't say I'm a luxury expert, I would say, but I have been keeping my ear kind of close to the ground since we started our exchange and started working in the rare whiskey market. But I think the luxury had a tough time last year in general. I think the ones that remained more resilient were the segments of the market that were, well suited for things like online auctions, things like handbags, especially. Maybe unsurprisingly, drinkable investment assets also tend to do well during downturns. Maybe people are drinking their sorrows away, but both wines and rare whiskeys have shown good gains over the past year. Not only because of increased global interest, but like I said, there's a rise of a more efficient secondary market sales channel. So for example, at Funnel, we recently launched our private exchange called HGX. And one of the first things that went live were actually rare casks from Diageo that we had digitized into asset-backed tokens. So essentially one token is equal to one bottle of rare whiskey, and investors can trade these tokens on the exchange until bottling date, when the investor can then choose to have the bottle delivered directly to them from Diageo. So channels like this essentially make the asset class more accessible and liquid, I would say. In terms of art, I do have a bit of view in this. The high-end market was pretty badly affected by the pandemic. I think Sotheby's, Christie's, and Phillips, which are the top 3 auction houses in the world, saw their sales fall. I think it was over $2.5 billion in the first half of last year. However, like I mentioned earlier, what they did see was actually a rise in their sales through their online auctions. Because it allowed them, basically to reach out to new art collectors who were not part of, this very traditionally very closed ecosystem. And when I talk about this, I'm sure many people will probably be thinking to NFTs. Marco can probably touch more on this than I can, but, and the artwork by Mike Winkelmann, or Beeple, as people know him, that recently sold for $69 million through Christie's, which actually makes him one of the most expensive living artists to date. I was actually just talking to a friend of mine about it this morning. So I think he's on the webinar, actually. Shout out to Angelo. But for those who aren't aware, NFTs are non-fungible tokens. They're basically electronic tokens representing something unique, say a website domain name or a digital piece of art. And these tokens in turn use cryptocurrencies like Ethereum usually to run and validate. And I think it's important to note that NFTs are not the item itself. It's just represents the ownership of the item, like the deed to a house. And I think that this market is very large, which makes it quite interesting, actually. The global collectibles market alone is around $400 billion. Add in all the value of artwork, it goes to over $1 trillion. So it's interesting. I think investors just have to remember that NFTs are only as good as the underlying asset itself, and that they have to trust basically in the crypto currency system itself. But my general advice thematically would be, I guess, only invest the money you can afford to lose in these kind of risky assets like
Do you think it's a bubble? Do you think it's a bubble, Carlos? NFT art?
I don't think so. I think it's just begun. So so we're just beginning to see that growth. I think it's way too early to say we're at a bubble moment.
Mm. Okay, good. I guess we're just coming to the end of the panel session. Maybe I could hand it back to Eunice. I noticed a couple of questions on the Q&A. Eunice?
Yeah, that's right. How about we go through one of the questions in the chat, right? About from Shitij about family offices playing more. No, not that one. My bad. The percentage of total portfolios family offices are looking to allocate in private tech opportunities. If anyone would want to jump in there.
Yeah, maybe we think. Do you want to take a stab? Percentage of portfolios going to private tech.
Percentage of portfolio allocation going into private tech opportunities. I actually am not entirely sure. Like when the family offices come and invest in us, I don't know what their total AUM is. Marco might be a better person to answer this question.
Also, I'm actually sure that I don't know the total AUM of all my clients. So definitely among all the private investments, I would say there are, at least from our clients' perspective, there are two trends that I noticed. One is that families tend to allocate a lot into places where they have a pre-existing experience, exposure, because of course they can rely on their historical understanding, their web of the network. It's pre-existing, so they can sense check deals. They usually have a much better ability to implement the deals. If it's real estate, for example, if a family is in real estate, they can take advantage of a good deal better than I could, and they can assess whether the deal is a better deal than I could. So this is the first thing. The second thing I can say is among the various thematics, tech, especially digital, and biotech are the two most invested in the space, at least for our clients. Specific percentage is really variable, so it's really a function of the family. So I would say probably a random number. No, that is an average, but this average is going to be composed by very distant data points. So specific percentage, maybe I would refrain from saying, but I would say that among all the various direct investment, tech and biotech among our clients are the two biggest ones.
I can add on to that. I mean, for us, you know, I don't know the percentage again as well, but for our family offices that have invested in us, I mean, they're, I would say mid-single digits are kind of their, you know, average commitment. And obviously that depends on how, again, like I said earlier, their risk appetite and what they're comfortable with. One of the things that we do make sure that we, you know, enforce with or no, not enforce, but like share with our family offices is that it's a two-way conversation. So a lot of the family offices actually want to diversify into areas they're not familiar with. And these tend to be family offices that have essentially made their money in very core traditional businesses. And they realize that, you know, they need to get access into this technology-enabled world in order to, you know, be ready for the next generation. And so they do that by choosing to diversify their portfolio, and some of that portfolio allocation goes into funds that are tech-enabled or focused on making tech-enabled investments.
Eunice, maybe there's another question I see, right? On, I think more on Carlos' side.
Yeah, so Carlos, how does the platform ensure the authenticity of the products being traded on the secondary market? Example, rare whiskies. I think this is regards to HGX.
Sure, yeah. I think a major part of that is we work directly with the suppliers. In the case of the whiskeys, it's working directly with Diageo. So Diageo still holds onto the casks in their facilities and will just deliver them upon bottling date. Another thing is that the exchange itself would take custody of the assets. So obviously we would go through all the measures, or the exchange would go through all the measures to ensure that the authenticity is there, because the liability will ultimately fall on the exchange itself. So it's in our best interest to make sure everything's authentic as well.
If I can add on this, I mean, in general, it's a very difficult problem. So how do you establish authenticity of a real world asset is very, very difficult. I saw a startup, an Israeli startup, that has a very interesting solution. They sprinkle diamond dust onto a small QR code looking thing, and the diamond dust will project a pattern of light that is extremely unique and very difficult to replicate. And then you can just scan it with your phone. And so that's a way to, probably you have to justify, the item should be of a value that justifies sprinkling diamond dust on it, but that's the limitation of this solution.
Okay, good. Are there further questions, I guess, Eunice?
Let's just take one more question before we talk about the next week's event, right? So we have a question here from Hazwan. I guess this is for everyone to share their thoughts. In your experience, given the various sizes of family offices, how do you see the challenges of family offices in the last 1 year and going forward in getting access to private market, private equity deals or investments?
Shall we go around the table? Maybe Marco, let's start with yourself.
I mean, I partially touched upon it also before. So our client vary very much in terms of size. And so there is a big difference in terms of their ability to access the deal and even their ability to access funds. Probably this will continue because there is more and more interest and there is more and more accessibility to the space. So this is going to be a problem also going forward. At the same time, hopefully the supply of this kind of deal and of funds will increase, because thanks to technology, it's going to be cheaper for a fund to be able to offer a co-investment opportunity, and it's going to be cheaper for a fund to be able to manage their cap table, and so they can have a smaller and a larger number of investors. And so these two forces, I'm not sure exactly how they will evolve over the near future. I would say that technology moves in jumps, so probably it's going to become, a harder market for a little while until finally someone figure out a solution, and then it makes everything much cheaper, and the supply spikes up quickly, and makes it much more accessible.
Carlos, your thoughts?
Sure. Yeah, I think I shared a little bit on kind of like the deal flow access, but I think one other challenge that I see a lot of family offices face when they look at private investments is around valuations, especially when it comes to very early stage investing. And I think this is especially true for a lot of the people that come from a more traditional finance background. A lot of them have a hard time realizing that startup valuation is totally disconnected from the typical kind of Wall Street style of business valuation done through, analyzing revenues and cash flows and growth rates, et cetera, et cetera. I think they have to realize that the key to startup valuation is that it centers, around the probability that a company will, basically become really, really big. So basically, it's functionally based on the probability of achieving the size of the upside. So things you want to look out for are good founders, huge addressable markets, but also companies that are working on difficult problems to solve and doing that well. Some questions you'll want to ask are things like, how big is opportunity and how much traction do they have? Has the founder done this before and sold a business in the past? All these will affect that probability. So I guess the next natural question would be, what exactly is the right price to pay? I don't think there's any shortcuts to learning this. You just have to talk, again, the theme about connecting and kind of inserting yourself into the ecosystem. To learn about pricing, you just have to talk to enough investment professionals that have been in this space, who've been doing it for a while, who've seen a lot of startups, and you'll get a better sense and a better idea. But I also think that not all expensive deals are great, but I think you can assume pretty safely, I guess, in an environment where, capital is so abundant across all stages of capital, that the great deals will tend to be priced at a bit of a premium. So yeah, that's kind of my final thought on that.
We think maybe your final words on this point.
Yeah, I think the difficult challenge for family offices is, everyone's always looking for the golden egg deal, I think, right? But it's very difficult to determine what that is. I don't think anybody can actually pick and choose. There's no Midas touch, no, more correct choosing way of choosing what's going to be a unicorn. Ultimately, I think, if you're going to make private investments, it is a numbers game. And it is, everything that Carlos and Marco have said are true. How do you know what the right valuation is? But I think more importantly is, how do you calibrate right? And the only way you can do that is by looking at a quantity of deals to calibrate right. So you might have great founders, but how do you know how good this founder is truly? So if you only see, let's say, like 5 deals a month, or let's say even 5 deals, a quarter, it's very hard to calibrate what good looks like if you're not constantly feeding yourself with just meeting founders in the ecosystem. So I think that's one thing. And then obviously, your risk appetite and how large of a commitment you can make really determines the types of deals that you do get to see. So for example, for the really hot deals, they don't actually even need to come into the market to raise the money. All they have to do is tell one person or 2 people, and the round is full. And so for a family office that's doing a direct investment, you'll never be able to get into that deal. Actually, funds ourselves, unless we have a direct link to those types of founders, it's also almost very difficult to get allocation into companies like that. But those are the types of companies usually that are going to see your $1 billion valuation in 2 years, something ridiculous.
Yeah, good. I guess to round it off from my perspective, I definitely agree with Marco's view, right? That technology is the big enabler here, because from both a platform perspective, just the democratization, right, of deal access, and having investors sort of have that open suite and menu into what areas they want to go into, and also from, I guess, enabling new types of investments, right? If you see the different kinds of products that are coming up in future, a lot of them seem to be actually technology enabled, be it NFTs and platform plays, right? So to me, it's all tech, right? Tech as a big enabler. Eunice, I guess top of the hour, I'll hand it back to you.
Yeah.
To round off.
And thank you, Marco, Hui Ting, and Carlos. Some really good insights there.